Hello everyone, and welcome back to another episode of Simply Wall Street's Market Insights. My name's Michael, and this week we'll be discussing 7 investing lessons from 2024. At Simply Wall Street, we believe successful investors follow 3 principles. Firstly, think in decades, not months. Secondly, reach your own conclusions. And lastly, be a lifelong learner. This is our last newsletter of the year, and a good time to focus on the third of those principles, the investing lessons we can all take away from 2024. It's been an eventful year, and there have been lots of opportunities to learn. We've narrowed it down to 7, but we would love to know if you think there are others to add. If you're experiencing deja vu, fret not, because we did do the same thing back in 2023. If you missed last year's lessons, there's a link to our 7 investing lessons from 2023 in the article. Before we dive into what happened in markets this week, though, here's our quote of the week from Leonardo da Vinci. "Learning is the only thing the mind never exhausts, never fears, and never regrets." Now, let's dive in. Here's a quick summary of what's been going on. Firstly, from Forbes, Nasdaq Composite crossed 20,000 for the first time. What's our take on this news? Stock prices can move very quickly or very slowly. The Nasdaq Composite took 17 years to get from 5,000 to 6,000, which is 1.08% per year. It's taken just 4 years to double from 10,000 to 20,000, which is 19% per year. Of course, the move from 5,000 to 6,000 included a 75% decline after the dot-com bubble burst and a 53% drop during the GFC. It finally regained the 5,000 level in 2015. During the Nasdaq's lost decade, other investments around the world did very well. Just remember, sectors, industries, and companies have their moments in the limelight, but nothing lasts forever. Next up from Quartz, Trump's FTC chair nomination points to a very different focus. What's our take on this news? A more relaxed FTC could be a key factor in 2025. Antitrust regulation is a double-edged sword. On the one hand, monopolies and corporate action that reduces competition can stifle innovation, give consumers less choice, and lead to higher prices. On the other hand, without acquisitions, venture capital funds have less opportunity to exit investments and reinvest in other startups. Lina Khan, the outgoing chair of the Federal Trade Commission, has been controversial from day one and received both support and criticism from across the political spectrum. She took a hard line on M&A and other anti-competitive behavior, particularly when it involved big tech. Donald Trump has appointed Andrew Ferguson to take over. Ferguson also promised to crack down on big tech, but in his case, it's because of their vendetta against competition and free speech. Outside big tech, he's expected to take a more relaxed approach to mergers and to the regulation of AI and other emerging technologies. Next up from Reuters. Ad giant Omnicom takes aim at big tech, AI era with $13 billion Interpublic deal. What's our take on this news? Regulators aren't the only ones taking on big tech, and industry consolidation is one way to adapt in a world where they're eating your lunch. With increased self-serve and AI tools being offered by the likes of Google and Meta in their ad businesses, traditional ad agencies need to keep up. The goal of this merger is to combine the talent, resources, services, and capabilities of both firms to better serve their clients. Some customers include the likes of Apple, Disney, Volkswagen, Johnson & Johnson, and Levi Strauss. As mentioned, with the new FTC chair, the deal is less likely to face regulatory scrutiny, which, if successful, would create the world's largest ad agency. If finalized, the companies would merge by the end of 2025, and Omnicom and Interpublic shareholders will own the final entity at about a 60-40 split. Next up from the Financial Times, India's second-largest renewables company plans to delist from the Nasdaq. What's our take on this news? It's a hard spot to be in when not only are you associated with bribery accusations, but you're working in clean energy, have a load of debt, and a Trump administration is on the way. Renew is a part of a group of companies led by the group Adani Clean Energy, and it's planning to delist from the Nasdaq and go private. This was spurred on by a 30% share price decline since its IPO in 2021. While the shares are now trading at $7.46, which is more than what's going to be offered, some analysts believe they'll have to offer shareholders even more than that. Other analysts mention that the biggest challenge is the US listing itself, and that it could possibly relist in India later on with a fresh capital raise. The volatility of revenue from its wind portfolio and its high debt level are a concern for some investors, but clearly not the consortium that would buy out existing shareholders. Next up, also from the Financial Times, business leaders warn Reeves about the impact of her budget tax rises. What's our take on this news? UK businesses will likely have a lower appetite for spending when these increased taxes are passed. Planned employment reforms and tax raises have many business leaders concerned in an environment that is already economically challenging. The government proposed increased government spending and investment in its 2024 budget. The issue is, it's looking for businesses and individuals to help foot the bill with higher taxes and additional government borrowing making up the difference. However, those business leaders warned there may be unintended consequences in the economy, such as lower recruitment and lower investment due to these higher taxes. So, it seems like companies will either cut costs to make up for the increased taxes, or you'll see their net margins contract as a result. And lastly, from Sherwood, Micron scores $6.2 billion deal from Uncle Sam as the China chip war sparks US investment. What's our take on this news? The tit for tat between the US and China will benefit some companies and hinder others. As the 2022 CHIPS Act continues, semiconductor companies like Micron, Intel, and TSMC continue to receive government funding to onshore chip manufacturing. The Commerce Department wants the funds to help increase the US's advanced chip production from 2% to 10% by 2035. Both China and the US are trying to make their chip industries more self-sufficient, but the incoming US administration might take a different approach to the same goal, given they've criticized the cost of the CHIPS Act. Now let's dive into our 7 investing lessons from 2024. First up with lesson number 1. Expect to be wrong on some ideas. In January, we listed the themes Wall Street strategists saw playing out in 2024. There were some themes that strategists from various firms mostly agreed on, and some where they didn't agree. Most were optimistic about high-quality technology companies, Japan, India, Mexico, and US healthcare stocks. So, how did those calls work out? Well, firstly, high-quality tech shot the lights out. Secondly, India and Japan performed very well during the first half of the year, but lost some momentum in the second half. Thirdly, US healthcare is up about 2% year to date, but it's been the worst performing sector by quite a margin. And lastly, Mexico has been trending lower all year. The IPC index is down about 10%, and the MSCI Mexico index is down 24% year to date. On balance, those forecasts were quite good. 3 winners, 1 that underperformed, but ended flat, and 1 proper loser. Incidentally, there was less agreement about the direction of inflation, interest rates, and emerging markets. As it turned out, the inflation and rates outlook has been murky for most of the year. Emerging markets have also been complicated due to rates and China's economy. Every investor, even those highly qualified ones employed by the likes of Goldman Sachs and JP Morgan, will have ideas that don't work out. It's just the nature of dealing with uncertain outcomes in a world of unlimited possibilities. We can't avoid the losers, but we can mitigate the impact on our portfolios by not putting all our eggs in one basket, i.e. diversifying and limiting exposure to each company, sector, or country. We've added some great tools to the portfolio page to help you monitor your exposure to sectors, industries, and markets. Next up, lesson number 2. Models work until they don't. One of the reasons many investors expected a recession through 2023 and earlier in 2024 was the inverted yield curve. The yield curve is said to be inverted when the short-term rates, i.e. 2 years, are higher than long-term rates, 10 to 30 years. This has been one of the most reliable leading indicators for a recession over the last 50 years. In September, the US yield curve uninverted after being inverted for a record 783 days. At this point, a recession isn't impossible, but it certainly seems less likely than it has over the last 2 years. Recessions typically occur within 18 months of the initial inversion, so it would turn out to be an extremely early warning anyway. Historically, the bond market was regarded as the smart money and the most accurate predictor of future inflation, growth, and rates. Lynn Alden wrote a great post on the reasons it may be losing its edge early this year. She points out that bond markets have changed and central banks are a bigger part of the market than they used to be. In August, another recession indicator, the SARM rule, flashed a warning signal. At the time, Claudia Sahm, the inventor of the indicator, was quick to point out that its historical accuracy doesn't mean it will never be wrong. She developed the indicator during the GFC and adopted it because it had been accurate up to that point. It's not just economic models that have had a bad year. Alan Lichtman's 13 Keys to the White House model failed to predict Donald Trump's win in November. His model, which isn't based on polling but on 13 true-false questions, correctly predicted the winner in the previous 9 elections, but it failed on the 10th try. The lesson here is that no indicator, model, or rule of thumb is foolproof. We can use them as a guide, but not as something that will never fail. Next up, Lesson 3. A Goldilocks economy is good for equity prices. Most of the world's economy is now mid-cycle, and has been for most of the year. Mid-cycle typically implies that the economy is growing at a moderate rate, inflation is relatively stable, and interest rates are normalizing. During the second quarter, a few analysts pointed out that we had the ingredients for a Goldilocks economy. That means growth is neither too hot nor too cold. This can be good for business confidence, as decision makers are neither concerned about a recession nor inflation. A Goldilocks economy can also be very good for markets. Expectations usually aren't too high, which means things tend to turn out better than expected. Worries about stocks being overvalued can actually prove to be bullish too. That may seem counterintuitive, but when investors think the market is overvalued, they often stay on the sidelines and then capitulate when prices are even higher. The same applies to perceived risks. There are always risks to investing, but unless perceived risks turn into reality, typically stock prices keep rising. This proved to be the case during the second half, even before the US election. Next up, Lesson 4. Volatility is usually the time to take action. Just a few weeks into the third quarter, global markets were hit by a perfect storm, causing volatility to spike. The primary catalysts were the return of recession fears and the Bank of Japan raising rates, which caused the carry trade to unwind in a matter of days. It turned out that those catalysts were temporary and markets quickly recovered. That turned out to be one of the best buying opportunities of the year. The S&P 500 is up 18% since that correction, while the Nikkei 225 index is up 29% from the low. Sometimes market volatility leads to more volatility, but more often than not, it turns out to be a buying opportunity for patient, long-term investors. To take advantage of volatility, you need to know which stocks you'd like to own and the price you are prepared to pay for them. If you load those stocks into a watch list with the price alert, you'll know how to act when everyone else is trying to figure out what to do. Another theme coming into the year was geopolitical risk. We covered the major geopolitical risks in March. They included the wars in Ukraine and Gaza, China's economy, protectionism, and the threat of cyber attacks. Those risks are all still present as we head into 2025. Geopolitical events usually turn out to be a buying opportunity too. Some, like Trump's tariffs, turn out to be impactful for certain economies and companies. But for the most part, these events come and go without affecting markets too much. Next up, lesson number 5. The semiconductor industry is still cyclical. The semiconductor industry has generally been considered to be cyclical, unlike other technology and growth industries. New innovation drives demand, which leads to higher prices, increased capacity, and ultimately too much inventory, too much capacity, and a collapse in prices. More recently, analysts have begun to think it's getting less cyclical as it becomes more complex and the number of end-use industries increases. The chart below for Micron Technology in red and AMD in blue suggests it's still as cyclical as ever. In the last few years, the focus has been on Nvidia, which has enjoyed ongoing demand for AI infrastructure. But most of the chip industry is exposed to other industries where demand continues to be cyclical. The reason we mention this is that the semiconductor industry is exposed to nearly every important secular trend, from AI to automation, clean energy, EVs, and healthcare. If there's one industry worth getting to know, it's the semiconductor industry. Typically, quality companies in growth industries are always fully valued. The fact that chip makers are cyclical means you occasionally get the chance to invest at really attractive valuations. If you missed it, we did a 5-part deep dive on the industry earlier this year, and there's a link to that in the article. Next up, lesson 6. A lot of investors are still relying on hype and sentiment to make decisions. In 2021, the meme stock phenomenon emerged, and stocks with poor fundamentals traded up to ridiculous valuations. The stocks that started it all, GameStop and AMC, have since fallen by 98% and 96% respectively. One would have thought it would have ended there. Nope. Since 2021, we've seen a boom and bust in NFTs, now mostly apparently worthless, and SPACs, most down 95%, and those that are successful are well off their highs. Last week, we talked about institutional adoption of Bitcoin, some who view it as a speculative asset and some who view it as a long-term store of value. Somehow, Dogecoin is now the 7th most valuable cryptocurrency with a market value of $59 billion. We're still trying to work out the bull case for that one, and it is quite different from Bitcoin. All speculative assets typically have two things in common. The first is that the valuation can't be explained. The second is that the price typically collapses within a year. If something is an investment, you should be able to explain the valuation and the catalysts that back that valuation up. Speaking of which, we now have hundreds of excellent narratives from the community on the platform. You can check them out under the Community tab. And lastly, Lesson 7. Premiums can persist for a long time. In September, we made the case for the US market's exceptionalism premium. With the right environment, a virtuous cycle begins and attracts capital, entrepreneurs, and skilled workers. Equities in markets like the US trade at a premium because investors would rather pay more to have their capital in an environment likely to generate more innovation and growth. Unless something changes, the premium is likely to persist or even grow. This chart shows how the US premium, in green, continues to expand compared to other markets. The performance of the Magnificent Seven stocks in 2024 has illustrated the point. At the beginning of the year, they traded at a premium to the rest of the US market and to other markets, but they went on to justify the premium and continued to outperform. When you're working out what you think a company is worth, it's worth accounting for the premium and whether it's likely to remain, expand, or even contract. So, what's the insight here? Take the time to reflect and be a learning machine. There's a reason why Warren Buffett is one of, if not the greatest investor in history. He's a learning machine. He's constantly expanding his knowledge, learning from his past mistakes, growing his circle of competence, and challenging his existing beliefs. He's seen a lot of different types of markets in his time, and they have helped shape the principles and timeless philosophies that he follows to do what he does best. In order for us to benefit from the same approach, we should also take the time to reflect on the year that was. We should think about what investment actions we took, why we took them, and assess the quality of our decisions. Importantly, not based on the outcome, but based on the information we had at the time and the probabilities. By doing so, we increase our chances of making better decisions in the future and becoming better investors. To wrap up, if you'd like to read the key events during the next week, we'll have a link to the article in the description. That's all for this week's Market Insights and this year of Market Insights. Thank you so much for listening. We're going to take some time off, so we hope you have a great holiday and we'll see you in the new year. Until then, invest well. Simply Wall Street analyst Richard Bowman and Simply Wall Street have no position in any of the companies mentioned. This recording is general in nature. We provide analysis based on historical data and analyst forecasts only, using an unbiased methodology, and our articles are not intended to be financial advice. It does not constitute a recommendation to buy or sell any stock, and does not take into account any of your objectives or your financial situation. We aim to bring you long-term, focused analysis driven by fundamental data.